I did have one question.
Yes, ma'am.
Yeah.
Please.
I'm interested in the group to see what problems they had or situations that came up during tax season. Usually there's one topic, that just runs rampant, like sales of home or people passing away in estates or, you know, COVID-19 issues. I mean, we've got so many issues going on right now. I'm just curious to see what people were surprised they had to deal with.
Marcia, I think that's a great idea. If you post that in
Okay.
whatever they call that,
Yeah.
everyone gets an email. And if they respond, then next Thursday, we can dedicate the program to problems that were encountered during the filing season, that because a lot of those will still be on extension. And so that the game isn't over on April the 18th. It goes to
Absolutely.
the middle of October. So I think that's a great idea and would really appreciate
Okay.
it. And if it comes from you and not from me, maybe
Right.
pay more attention to it.
Right.
And I'll shoot some questions to you as well.
Please.
Just maybe on topics or, stuff that I encountered, maybe somebody else encountered, or I'd love to see what other people encountered that I didn't encounter that I need to do research on,
Just directly to my email. And of course, I do get questions from people all over the country. So I deal with not just questions from South Carolina. So that'll
nice.
be very useful. And I'll just make that commitment to you right now. We'll do next Thursday, if it's okay with Catherine, we'll just dedicate tax to the max. We have time for special topics. So tax to the max will emphasize special attention to problems encountered during the filing season, other than the IRS being 9 months behind.
Right.
Right.
Sounds good to me. Thank you.
Super. All right. Let's see if I can get this thing to work the way it's supposed to. Slideshow from the beginning. I can see you. I can see the slides. Let's see if they work like they're supposed to. They do. I added this slide since somebody said, well, who is this guy? And why should we watch what he's doing anyway? That's me. And that probably was the high point of my career back in 1995. They gave me their gold medal for contributions to the profession. And I thought, well, there's 14,000 members of that Ohio Society. So maybe they couldn't be all wrong on the same day. What's in the program this week? 10 items, a long list. South Carolina, they've updated a citator of all their advisory opinions. I'll share that information with you. Then I picked up an article from people that are contributing to tax notes today. Lack of enforcement, negligent enforcement is leaving hundreds of billions of dollars literally offshore. The IRS is not enforcing the law as it is written because apparently they don't have the people to do that. It's a long story that keeps repeating itself. Then we have a ruling which allows an individual to salvage an inherited IRA in spite of poor planning by her spouse. 2 split dollar cases. I think we're going to talk more of this over the next few weeks and maybe months about creative uses of split dollar life insurance in wealth transfer plans. The effect on an S election of joint and survivor grantor trusts. The Joint and Survivor Grantor Trust is a very popular way of handling estates for married couples that are planning to stay married. They're older. They don't have typically taxable estates. They want to eliminate a lot of grief. And so they have a Joint and Survivor Grantor Trust, which holds all of their assets. If that trust holds S corporation stock, there is a unique risk that we're going to talk about. And then this Schedule K2 and the Schedule K3 is everybody up in an uproar. We got disclosure still leaves big questions open. And the little brown guy there with the magnifying glass, he's related to that on K2 and K3. It is a great mystery, but for 99.9% of us, it is not anything we need to be concerned about. The IRS is seeking comments on Form 5213. You may not have known there was such a form, but this form allows you to stiff-arm the IRS from an examination of hobby losses until you complete the total number of years possible for testing. That is, you can stop the IRS from claiming you have a hobby loss until you have exhausted the total number of years that are required to be analyzed in connection with your activity. A ruling that the value of free flight tickets is includable in income. They say, wait a minute, that can't be right. The airline gives free flight tickets to their employees and they use them. If that's what happens, they're not taxable. But what happens if the employee allows a family member to use the ticket? That's different. And then next to last this week, more updating to the recovery rebate credit frequently asked questions. God knows when we're ever going to get out of this. I think 2021 is going to be the last year we have to worry about the recovery rebate credit. And finally, in this program from time to time, and fairly often, I've cautioned you to be careful practitioners, to always read the entire code section, to read references. If what you're reading references something else, go read the something else along with what you were reading in the first place, and always read the fine print. Well, that's the plan for this week. Here we go. South Carolina Advisory Opinions Citator, one of two, 67 pages. And that's where the fright wig came from, all right? From 1987 through 2022, anything and everything you ever wanted to know about what the Department of Revenue has said about South Carolina tax law at the time. This index, issued by the department from 87 through March 31st, 2022, will provide you assistance in determining what effect new advisory opinions have on those that are previously published. But that's not all. It does not include the effect new laws, regulations, or court decisions have on previously issued advisory opinions. So here's the deal. You have to understand South Carolina tax law to start with. You have to have some understanding of how the law has changed and when to start with. But if you simply need information about the details of how a change in the law was to be administered or is to be administered, and you're working on tax returns that might have been 3 years old or 5 years old or even 10 years old, then you need the South Carolina Advisory Opinions Citator. And if you didn't know it was available before now, now you do. Hundreds of billions left offshore, dollars, euros. This is an article by Martin Sullivan, who writes for, he's a contributing writer for tax analysts. I was attracted to it because I understood it. I don't always understand everything that is written about U.S. taxation of foreign transactions and offshore, and it gets really complicated. And, you know, I started out doing 1040s in Oklahoma in 1964. So that was a long time ago. And my practice has always been fairly simple. So you start dragging me through a lot of international tax rules and treaties and whatnot, I can get outside my comfort zone real easy. So what Mr. Sullivan has written is an 8-page summary of the U.S. tax law that applies to international transactions, a simplified introduction to approaches that could be used and might be used by some of these large corporations to limit profit shifting out of the United States. It's a guide for practitioners that, like me, are not immersed in international tax law. It explains these major tax dodges: aggressive transfer pricing, which frankly is old hat; So we'll leave that. That's easy. That's not even anything that you could get excited about. Effectively connected income, designing your income so it is effectively connected to another jurisdiction. Base company income, making sure that base company income is identified in another jurisdiction. Arguing that the taxable income should be commensurate with the top line income, which would have the effect of shifting profits out of the United States into a lower tax jurisdiction. And then the economic substance doctrine. All of these take advantage of outdated law, 1962, and regulations with regard to this whole issue of profit shifting. If you're clever and if you're well educated, you can use one or all of these methods to shift profits away from the United States into a foreign jurisdiction. You don't even have to move the money. You can just move the recognition of the profits. Tax Notes Today, April 11th, 2022, an article by Martin Sullivan. I highly recommend it to anyone who wants to know more about international taxation and profit shifting, but doesn't want to attend classes for a whole semester. These four non-standard approaches, effectively connected income, base company income, commensurate with income, and economic substance doctrine, those are the titles that are given to those non-standard approaches. And if you're doing research, you want to look up those terms. Those are the terms that will help you find an explanation of what's going on with that approach. Then an individual salvages an IRA from her husband's estate. Here's the deal. His last will and testament left everything to her. So the proceeds of his IRA went into his estate. Oh boy, that can't be good, because they're going to be either immediately taxable or we got to have them paid out over 5 years or maybe, oh dear. So that was number one. That's what happened. But in the estate, the spouse is both the sole beneficiary and the executrix. So there is no way that any money can get out of that estate to anyone except her. It's her money. So it's the same as if the IRA was left to her, as if, so she should be able to roll it over to a spousal IRA. But meanwhile, it wasn't left to her IRA. It was left to the estate. She's got to get it out of the estate. And for that, she needs a ruling. The ruling is not terribly expensive unless you've got a net worth over $10 million, and then it gets expensive. But you're going to have to take the time, get the ruling where the estate, where the spouse is the sole beneficiary and the executrix of the estate. So there's no way that anybody but her can get money out of the estate. Then she can roll the deceased spouse's IRA into her spousal IRA and then make the distributions over her life expectancy rather than his, or rather than some 5-year or some artificial timetable. Well, looky there. There's a stage, that's stage money. That's a $100 bill split. What do you think I want to talk about? How about using split dollar life insurance policies to reduce the value of an estate? This is slide number 1 of 2. A split dollar life insurance arrangement used in an estate plan involves an irrevocable trust that holds life insurance policies on the lives of the heirs of the grantor of the trust. The trust has an agreement that the grantor or the trust will fund the purchase and premiums of the policies. In return for that, the trust has an interest in the policies. The interest that the trust has is to recover all the money it has advanced, so that if an heir of the grantor dies, the trust recovers the amount of money that has been advanced to pay the premiums, but not the proceeds of the policy. Wow. Or what if the heir does not die? Well, the trust has been paying the premiums and they have a right to recover the premiums. But meanwhile, what happens in a whole life policy? The inside buildup of the fund grows tax-free. So after 20 years, the trust has a claim on all the premiums it's paid. Give me back my premiums. But the increase in value in the inside buildup is yours. A tax-free transfer of wealth using a split dollar life insurance policy. The grantor and the trustee enter into an agreement requiring the grantor to annually pay the premiums on the policies. That is secured with a collateral agreement on the policy so I can get my money back. And the payments, the value of the payments can be deemed a gift by the grantor. It can be deemed an interest-free gift. I don't know, like code section 7872, something like that. The grantors could also take out loans to finance the premiums, creating a debt owed by the estate that would reduce its value even further. Using split dollar policies to reduce an estate. I was on the phone. Many of you know my colleague, Mike Tucker. I was on the phone with Mike Tucker this morning talking about this very thing. I wanted to see if what I thought about this was consistent with his thoughts. And Mike agrees that as a profession, we CPAs have not been paying enough attention to the use of the split dollar life insurance policy as a wealth transfer vehicle to reduce the value of an estate while protecting the interests of the wealthy person, as well as the interests of all of the heirs. Sometimes it just takes a little work. And when you start a program like this, you have to be committed to keep it. This is not one of those things that you try out. You either do or do not do. As Yoda would say, there is no try. There is only do or not do. These two split dollar cases illustrate the current state of affairs. The estate of Marion Levine is a taxpayer victory. It is distinguished on its facts from Morissette and Cahill. Only the insurance trust could terminate the agreement. Levine, who was the donor, could not. Now, in Morissette and Cahill, the donor had retained the right to terminate the arrangement. We have a memorandum being filed in the estate of Arthur Citator, the founder of one of the, J. Crew was the company that he founded. This is in litigation right now. IRS alleges the debts are overstated by 32 million, taxable gifts understated by 92.7 million. And in this arrangement, either the insurance trust or Citator could have terminated the agreement at the end of any policy year, and that's a quote. Is that going to be fatal? I don't know. The donor and the trust in Morissette and the donor and the donee in Cahill could mutually agree to terminate the arrangement. So according to the IRS and then according to tax court, the donors in each case retained an interest or a right in the property transferred. It wasn't a right to get any money. It was a right to terminate the arrangement. That was enough to make the property part of the estate. In Levine, only the insurance trust, remember, could terminate the agreement. That meant the donor did not have any sort of possession or rights to their cash surrender values. It wasn't just they couldn't take it, they couldn't push it away either. So the right to push it away is a right. It's a possessory right. So the values were not included in the estate. So, excuse me, question. In Citator, which is in litigation, I think the agreement clearly should have expressly stated that only the trustee could terminate. The question that's going to be decided here, and the question that really needs attention, is the right to terminate a possessory right. is it the same? Is the right to push away treated the same as the right to take? I don't think so. And I don't see how the court gets to the decisions that are being suggested. Is this a fail? We'll find out. Now, you'll recall my remarks at the opening about an S election affected by a joint grantor trust. Actually, my remarks were about the joint grantor trust and how handy it is. But if you allow the joint grantor trust to own stock in an S corporation, here's what happens. And this is analyzed by an article by Alan and Ryan Montgomery, published in Tax Notes Today on the 12th of April, while we were all busy doing other things. Following the death of the first spouse, a joint and survivor grantor trust remains an eligible S corporation shareholder. No problem. You don't have to do anything. No electing small business trust or qualified subchapter trust election is required. But after the death of the surviving spouse, what kind of trust is this? After the death of the surviving spouse, unless you have an electing small business trust election or a qualified subchapter S trust election made, you're going to kill your S election. And that happens again and again and again. It is the most common reason for unexpected termination of S status, and it requires a letter ruling to fix. How do you then get ahead of the problem? Is Nichols just here to wave the red lantern and say, danger, danger, beware, beware? No, no, no. I don't want to come with a problem without suggesting a solution. How do you avoid automatic S status termination? A trust must never be permitted to become an S corporation shareholder unless it is qualified. That's a short list. It requires the type of trust that assures all income attributes, all income, all credits will be allocated among shareholders pro rata in accordance with their number of shares held for the number of days. No special allocations. To assure a joint grantor trust does not terminate the election upon the death of the last grantor, the trust document has to provide an obligation for the successor trustee to take action necessary to immediately elect to be a small business trust. That is, no passage of time. No, you couldn't even slip a piece of paper in there, right? No passage of time between the death of that first to die, and now you're operating very dangerous territory, because if the second to die dies before you have an alternate arrangement in place, then you're going to terminate your S election. So no further filing with the IRS will be required if you draft that trust document correctly. So this is where the CPA, with the tax knowledge and some tact, some diplomacy, needs to suggest to the attorney that we need some special wording in the attorney's favorite trust document so that we don't terminate an S election if we're going to put S stock in that trust. Oh yeah, here we are, the K2 and the K3, more guidance. Look, the K2 and the K3 are all about compliance with the US tax laws on foreign transactions. IRS has added 8 Q&A to the list of frequently asked questions on schedules K2 and K3, same questions on both schedules. The new questions address the mechanics of preparing the schedules, such as which lines to complete and which identification codes to use. There's more complexity in the K2 and the K3 than there is in the entire balance of the return, if you have exposure to foreign tax credit being claimed by any partner. The lines that are emphasized in the new guidance only apply to pass-throughs and their partners and shareholders, because K2 and K3 are applicable to partnerships and S-corps that have items of international tax relevance, and that's a quote. Domestic partnerships with all domestic partners, some of whom are known to have foreign tax credit reporting needs, My phone has decided to, it's coming through in my hearing aids, and that's distracting. Domestic partnerships with domestic partners, some of whom are known to have foreign tax credit reporting needs, still need a Schedule K2 and a Schedule K3. How am I going to know that? I have to ask the question. And the partners must represent to me, one way or the other, that no, they're not filing a Form 1116. If any partner is going to file a Form 1116, then as I read the instructions for K2 and K3, then the partnership is obligated to produce the schedules K2 and K3 with whatever additional professional time that takes, and burdening the other partners who are not going to file 1116s with the cost of the professional fees. Is it much ado about nothing? Well, many advisors thought the language in the who must file section you only had to worry about a partnership that had foreign operations or foreign equity holders. Not so. We originally thought, well, I don't have any foreign partners and I don't have any foreign operations, so I don't need to worry about K2 or K3. That's the big red not so. In a January 18th update, which we talked about back in January, IRS said entities with no foreign activities or equity holders might still need to complete parts of K2 and K3 if a partner or shareholder claimed a foreign tax credit and needed information from the entity to complete the Form 1116, as I mentioned on the preceding slide. So even partnerships with only domestic partners could have filing obligations if the partnership, here's the hook, makes certain deductible payments to foreign related parties of its domestic partners. Certain deductible payments. So the partnership is going to claim a deduction for payments that are made to entities or individuals that are related to its domestic partners. That's at least two more questions for your questionnaire. I think the threshold question is, are there any foreign involvements by any partners? Hopefully you get the right answer. The IRS has said they're not going to try to enforce this year, thankfully, but next year, watch out. Okay, here's a Form 5213. I have a client that has lost money in an activity, year 1, year 2, year 3, and we're being audited, and the IRS auditor says, I'm going to disallow all those expenses because it's a hobby. Stop. No, you can't do that. I've got more time. And the IRS agent says, you're not going to make any money next year either. And, well, I got a right to prove it. So I'm going to give you a Form 5213. This is my election to postpone a final determination of whether or not this activity is in fact not a trade or business. I hate to use the term hobby. This activity is not a trade or business, and the losses are not legitimately deductible. Well, here's the information. It's pretty common, name, address, right? So the taxpayer is going to postpone a determination as to whether the presumption applies to the 6th tax year if an activity consists of breeding, training, showing, or racing horses, or the 4th tax year for any other activity. I'm in year 1, 2, 3, I got losses. The IRS wants to disallow them. Stop, you can't do that until we finish the 4th year. I'm going to have a big profit in the 4th year. And since I have a big profit in the 4th year, you can't disallow those losses in year 1, 2, and 3. What type of taxpayer is this? Individual partnership, S Corp, estate or trust? Now I cut part of this form off. As you can see here, I didn't even try to hide the fact. See here, here's my finger. I know you can't see it exactly, but I'm gonna across the screen. There's a line through that shaded area. The whole form is an 8.5 by 11 sheet of paper, but there was no point in showing you this more blank space. But we get down to the bottom. There is a jurat under penalties of perjury. I've examined this election. So let's look at the next slide. The IRS is seeking comments on this form. Is it useful? Is it practical? Is it something that, in your experience, would be helpful? then you might want to tell the IRS that this form would be very useful in a situation where one of your clients had losses in year 1, 2, and 3 and expected profits in year 4. So it's too soon to disallow their losses. The value of plane tickets given to a pilot by the airline he worked for are includable in his income. All right, wait a second. No. I've been at this a while. I know about Code Section 132. I know that the pilot flying free on the airline is a no additional cost benefit. You can't stick me with income on that. Well, the facts are just a little bit different, Nichols, and so you're going to lose. What do you mean I'm going to lose? Well, let's get all the facts. That's always a good idea, don't you think? The value of fly free tickets, retiree travel benefits from his former employer. He's retired. He's got some fly free tickets used by his family. Oh, the retired commercial airline pilot's family, not the pilot, not the individual who was the employee, but his family. Those should have been included in gross income on his tax return. The employer reported the value to him on a 1099 miscellaneous. So he had the form in his hand. He knew what he was supposed to do. He didn't do it. Who's right? Well, it's always a good idea to go back and look at the law. Douglas Mihalik, TC Memo 2022-36, the value of the tickets was not excludable under Section 132. It was not a no additional cost service because he wasn't using them, and the relatives were not his dependent children, which would have qualified, nor were these tickets de minimis fringe benefits, meaning that they had no value, like donuts, right? The employer puts out a box of donuts every morning. Well, who counts how many donuts, who ate what the donuts? That is a de minimis fringe benefit. But this wasn't de minimis fringe benefit. This is $5,400 worth of fly free tickets. It's taxable. He should have paid attention to the 1099 miscellaneous, as should his return preparer. But we're beset with the scourge of what is it? Tax, whatever it is. Anyone can do their own tax return. The television commercials, if it's not a car dealer or a personal injury lawyer, it's some outfit that wants to do my tax return for me. And or show me how to do it myself. H&R Block even has a do-it-yourself package. Frightening, absolutely frightening. More on the recovery rebate credit. 2 columns, okay, because we got 2 information releases, 2022-83 and 2022-82. These are 2 fact sheets. One updates frequently asked questions on the 2020 recovery rebate credit. The other on the 2021 recovery rebate credit. One is to be used for your 2020 return. The other, the most recent, to be used for your 2021 return. Now, we can't possibly go over all of the Q&A in this short program, but here's the reference. There's the fact sheet is FS 2022-27. The IR reference is the information release. That's the press release that the IRS issued, trumpeting their success in giving you information on how to claim the recovery rebate credit. The IRS provides relief from failure to deposit penalties. Wow, no kidding. Relief from penalties just without asking? How could that they finally have come around to my way of thinking. No one should have to pay a penalty if they're trying, right? Notice 2022-15 provides relief from penalties under Section 6656 for failure to deposit. Excise taxes? What do you mean? Excise taxes imposed on specified chemicals and on some imported substances. Section 4661, 4671, that's the Superfund chemical taxes. I don't have any clients that pay the Superfund chemical taxes. Oh, pooh. It's really important to read the whole thing. If I've said it once in this program, I've said it at least a dozen times. It's really important to read the whole code section, because the way the code is drafted, the code section, the absolute statement is up front and the exceptions follow. And if you don't read the exceptions, if you don't read the whole thing, you're going to make a mistake. And it could be it could be embarrassing, or it could be the end of your career. That's what's dangerous. So let's continue to meet, please. I really love these meetings. Marcia, I suppose we could keep them secret if no one else shows up. We're going to feature current information about developments in administration and interpretation of federal tax law. Next week, and maybe the week after that, we're going to focus on problems we encountered during what's called the filing season. Things that interfered with smooth operation of your preparation of tax returns because you had to stop and dig out the answer to an unusual question. Some partnership liquidated, or somebody, Aunt Hortense died and left all of her stuff to Uncle George, but Uncle George doesn't want any of it. So all those things, all those questions that cause questions to come to me during the filing season, we're going to talk about for the next week or so. Thank you all for your participation and your support. Those of you that are here. Thank you. Marcia, thank you.
Thank you.
Keep me honest. And for all of you that will look at this program after next Monday. Meanwhile, God bless.